What's up, family? Andre Gordon here. On this episode, we are going to examine the mysterious world of private equity. You've probably seen in the news lately a lot of unfamiliar names that are taking over large, established brands and companies. We're going to examine what private equity is, give you a better understanding of it, and how it can impact you and your money. But before we get started, please don't forget to smash the like button, hit the subscriber button, and the bell next to it in order to receive updated weekly content. You have probably heard of the term private equity. This is the industry that has about $3.9 trillion worth of assets as of 2019. And this is the industry where investors seek out a much higher rate of return comparative to the equity markets that you and I participate in. But let's first establish what is private equity. Private equity is ownership or interest in an entity that is not publicly listed or traded. Source of investment capital. Private equity comes from high net worth individuals and firms that purchase stakes in private companies or acquire control of publicly traded companies with the goal of eventually taking them private by delisting them from the stock exchanges. The private equity industry is comprised of institutional investors such as pension funds and large private equity firms that are run by accredited investors. Private equity often entails direct investment or capital to gain control of a company's operations. A significant amount of capital outlay is required. That is why many of the larger firms or large net worth investors dominate the private equity industry. The minimum amount of capital required for accredited investors varies from firm and different funds. But a starting point for many firms is $250,000 of initial investment, with other firms going as high as $5 million for their initial investment. The intrinsic motivation for such a significant financial commitment is the pursuit of positive return on investment, or ROI. Many of the partners at the private equity firms raise funds and manage monies to yield favorable results for their shareholders. Typically, the time horizon for these type of investments are anywhere between 4 and 7 years. The private equity industry attracts the best and the brightest from corporate America, often coming from Fortune 500 companies and elite management consulting firms. Many law firms and accounting firms also serve as great recruiting grounds for private equity business, as many of the legal and accounting transactions that are required for deal making are sought after competencies and skills within the private equity industry. Fee structure for private equity firms varies across the industry, but they always typically include two components: a management fee and a performance fee. For example, a yearly management fee of about 2% and a performance fee of around 20% of gross sale of the assets upon completion of that sale is typically what you see in an incentive program. Given that a private equity firm with $2 billion of assets under management, or AUM, might only have maybe a dozen investment professionals, you can see that with a 20% gross on the sale of assets that can generate tens of thousands of dollars in fees, that this is a highly lucrative industry, and positions within that industry can run well into the 6 or 7 figures. The level of compensation can vary amongst firms within the industry, but also can vary amongst positions within those firms. For example, many of the middle market management within private equity firms can earn well into the 6-figure range for salaries per year, with many vice presidents within those same firms earning anywhere from $500,000 to $750,000 per year. But the principals who own a majority of the firm or the fund can earn well into the $5 to $10 million per year range in terms of compensation. Private equity firms have a range of investment preferences. Some are strict financiers, while others are passive investors who are wholly dependent on management to grow the company and generate returns. Many within the private equity industry may see this as a commoditization approach, while other private equity firms consider themselves to be active investors, meaning that they like to provide operational support to management and see themselves as a part of the management team that is charged with helping build and grow the company. Many very proactive private equity firms have an extensive contact list and C-level relationships with CEOs and CFOs within a particular industry. That access and those relationships can help them be able to gain a leg up on the competition to increase their revenue. Some of these private equity firms may also be experts in operational efficiencies and synergies. This may bring value to a certain deal or transaction that an investor may look favorably upon in comparison to competition that is only focused on the revenue generating side of the business. Investment banks often compete with private equity firms as well as private equity funds to buy good, sound financial companies. And they also compete in order to finance companies that may not have a very secure balance sheet but have a huge potential and upside. Firms such as Goldman Sachs, JP Morgan Chase, and Citigroup are some of the largest investment banks that often compete against private equity for some of the largest deals. With private equity funds, the funds that they typically offer are only available to accredited investors. They also limit the number of investors that can have access to those funds as well. While at the same time, the fund's founders typically take very large stakes within the company as well. However, in some instances, some of the largest, most prestigious private equity firms actually trade their shares publicly. For example, the Blackstone Group, which you may have seen in the news lately, trades on the New York Stock Exchange and has been involved with several large buyouts of Hilton Hotels and Magic Lab. In order to understand private equity, it's important to understand that the value that private equity firms or funds bring to the table. Private equity firms perform two critical functions: deal origination or transaction execution, and portfolio oversight. Deal origination involves maintaining, creating, and developing relationships with merger and acquisition intermediaries, investment banks, and other transaction professionals to maintain both high quantity and high quality deal flow. Deal flow refers to the prospective acquisition candidates that are often referred to private equity firms for a thorough investment review. Some firms have an internal staff that proactively reach out to different firms, companies, and industries in order to be able to generate transaction leads. The very competitive M&A landscape, sourcing proprietary deals can help guarantee and secure that funds are properly deployed and invested. Competitive M&A landscape, sourcing proprietary deals on funds that are raised can ensure the successful deployment and investment strategy. Moreover, internal sourcing can reduce transaction-related costs by cutting out investment banking fees. Financial services professionals representing the seller, they usually run a full auction process that greatly diminishes the chances of the buyer being able to successfully acquire a particular company. In particular fashion, deal origination professionals attempt to develop a strong rapport and relationship with transaction professionals in order to get a leg up and introduction to any potential deals. It's important to also note, investment banks often raise their own funds. So therefore, they may not be an ideal referral, but instead a very potent competitor. Transaction execution often involves assessing management, the financial forecast, the industry, as well as conducting current valuation analysis. The investment committee signs off to pursue a potential acquisition candidate. The deal origination committee submits an offer. If both parties decide to move forward, the deal professionals work with various transaction advisors to include investment bankers, accountants, lawyers, and other consultants to execute the due diligence phase. After the investment committee signs off to pursue a potential target acquisition candidate, the deal origination professionals submit an offer to the seller. Due diligence includes validating management's stated operational and financial figures. This part of the process is absolutely critical, as consultants can uncover deal killers that can include significant and previously undisclosed liabilities and risks. There are a myriad of private equity investment strategies, but we're going to focus on two: leveraged buyouts and venture capital investments. Leveraged buyouts are exactly how they sound. A target firm is purchased by a private equity firm. The purchase is financed through debt, which is collateralized by the target firm's operation and assets. The acquirer or the private equity firm seeks to purchase a target company by using that target company as collateral. In a leveraged buyout, the acquiring private equity firms are able to purchase companies while only having to put up a fraction of the purchase price. Venture capital is taking an equity position in a young up-and-coming firm in a much less developed industry. Private equity firms often see the potential that is within an industry, but more importantly, the potential of that target company within that industry, and that they are hampered currently by the lack of revenues, cash flow, and debt financing that is available to that target company. Firms are often able to take significant stakes in these young companies with the hopes that the potential will turn them into a powerhouse within that industry and thus maximize the potential that's available to the private equity firm. Additionally, guiding the target firms, often very inexperienced management, the private equity firms can add value in an often less quantifiable manner. Oversight and management is the second most important function for the private equity profession. Among other important considerations, a private equity firm can guide an often young and experienced executive staff through some best practices regarding strategic planning and financial management. In addition to those categories, they can also add value for that young executive staff regarding new accounting principles, procurement, and IT services. When it comes to the subject of more established companies, private equity firms are of the belief that they have the ability and expertise to take underperforming companies and make them into much stronger ones by increasing operational efficiencies, which thus increases the earnings. This is the primary source of value creation in private equity. And private equity firms also create value by aligning the company management with the firm and the investors. One of the advantages of taking a company private is that it removes the daily scrutiny and focus of meeting quarterly earnings and reporting requirements. Now all parties involved, including the target firm's management and the private equity firm, can take a much longer-term approach to building the company's operations and thus their revenues. Management compensation is often tied more closely to this type of performance, thus increasing the level of accountability and aligning management efforts more closely with the firm and the investor. Management compensation is also more closely tied to the firm's performance. Thus, it increases accountability and then provides an incentive to any efforts by management. This, along with many other tools that's available to the private equity firm, increases the valuation substantially of the acquired firm from the purchase price. It also creates an extra strategy for the private equity firm that can include reselling the acquired firm back into the marketplace or spinning it off into an IPO, which stands for an initial public offering. One of the more popular exit strategies for private equity firms is taking a middle market company, growing and improving that company, and selling it to a much larger corporation for a hefty profit. Of course, to achieve such a hefty profit, much of the focus by deal professionals is focused in areas where multi-billion-dollar companies and industries operate. However, if you look at the actual transaction data for private equity firms, most of the transactions occur in that middle market, anywhere between $100 million and $500 million, with a significant portion of those transactions actually occurring in the market that's $100 million and below. As a result, many of the firms and companies in that middle market are severely underrepresented. There are far more sellers in this market than there are seasoned professionals who have a Rolodex of contacts and resources to be able to execute a deal. Rating below the radar screen, many of these middle market companies can offer much more of a vast opportunity than these large multinational corporations in terms of customer service, niche products, and services that can be able to complement their industry as well as the community as a whole. Flying below the radar screen of these large multinational corporations, many of these smaller firms can offer value that is not seen with these larger conglomerates. That would include higher quality customer service, niche products and services that can add value to a corporation and to a firm. Such significant upside is attractive to private equity firms, where there is very little competition and they can take a small to medium company and be able to help it grow and improve and take it to the next level within a particular industry. For example, you can take a small, mid-sized regional company that has been able to grow significant market share within a certain geography of the United States and grow their sales and revenue by opening up international markets to that organization. The focus can be on a highly fragmented industry that is undergoing consolidation and the opportunity for a private equity firm to come in and take a large position in one of those players can now put them in a position for the upside of that firm being number one or number two in a particular industry. As a result, larger companies tend to command higher valuations than smaller companies. So you can see the goal of a private equity firm is to build smaller to middle companies up to larger companies with the idea of maximizing their return upon their exit strategy. One of the more important company metrics that investors look at in terms of evaluation is something called EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization. A private equity firm acquires a company. They work diligently with the company's management to increase EBITDA during the investment time horizon. Experienced and savvy private equity firm can do this two ways. They can increase EBITDA organically through operational inefficiencies and through acquisitions. In order for this to take place, private equity firms have to have strong and capable management in place to execute. Most management compensation is tied to the performance of the transaction. Increasing EBITDA also increases the valuation of the firm, which thus increases the potential return on investment for the firm and its investors. Private equity is often thought of as out of the equation for people who can't invest millions and millions of dollars. But that is not necessarily the case. Many private equity investment opportunities require steep initial investments. There are many opportunities for the smaller investor to play in this market as well. There are several private equity investment firms known as business development companies that offer publicly traded stock. This gives the average investor an opportunity to own a slice of the private equity pie. I mentioned before, in this group you have Blackstone, you have the Apollo Global Management Group, you have KKR, which is well known for its leveraged buyout of RJR Nabisco in 1989, and you also have the Carlyle Group. Mutual funds in general are prohibited from owning private equity by the Securities and Exchange Commission, but they can indirectly own some of these investment vehicles by investing in the publicly traded equity investment firms. These will be known as what they call the fund of funds. Investors can also purchase shares in an ETF, which stands for an exchange traded fund, which also can happen to hold shares of private equity companies. The what's in it for my money for private equity is this. With funds in the trillions and trillions of dollars, the private equity investment industry has become an attractive investment vehicle for wealthy individuals and institutions. Understanding exactly what private equity is and how its value is created in such investments are critical first steps to understanding an investment vehicle that is becoming more and more accessible to the average individual investor. As the industry continues to attract the best and brightest in corporate America, the professionals within the private equity investment industry are usually very successful at deploying investments and being able to return the highest possible return on investment. However, there is fierce competition in the mergers and acquisition marketplace to find good companies to buy. As such, it's going to be imperative for these firms to develop strong relationships and a deep bench of talent and resources to be able to play successfully in the marketplace and yield the highest possible return on investment for their investors. Private equity is no longer just reserved for the uber wealthy. It has now become a part of traditional investment strategies that are available to the average investor. And that is it. Hopefully you now have a better understanding of what private equity is, what it entails, and how it can add value to your portfolio. Please don't forget to smash that like button, hit that subscriber button, and the bell next to it in order to receive updated weekly content. Thank you for tuning in.